Good morning. This is Tom Alexander. It's Monday, May 30th. It is Memorial Day in the U.S., a holiday. We've had some Globex trade. I'll go through that in just a minute. This is a video review of the report that you all should have received. If you haven't received it and you want to receive it, shoot me an email, tom@alexandertrading.com. I would appreciate it if you liked the video. I would appreciate it if you would subscribe. And by all means, if you have comments, put them in the comment section and I will respond. Okay, last week was a blast off of sorts that should continue. That's the bottom line. There's a lot of momentum generated the last few days of last week. We came into the week expecting the market to move sharply. You can reference last weekend's report, and I talked about that in the report. We were really at an inflection point. I didn't know it was going to be up, but I thought we'd have an extremely sharp move. I thought the market was on the verge of either one of these washout type crashes or what we saw. Let's go to the charts. These are the weekly charts of the 4 primary U.S. trading indices. And as you can see, we had a really wide range up week that closed on its high. The levels that you see on these charts are the important key reference areas as we head into next week. It would be extremely bearish if we were to, for any reason, reverse last week's gains and close below last week's lows in all 4 of the indices. That would probably be part of a crash type scenario. That's an extremely low probability event, but that would be, to me, what it would mean. Now, the upper key reference areas that you see highlighted, I fully expect one or more of the indices or all of them to reach these areas before there's any sort of significant retracement. Let's go to the shorter term charts. All right, these are the futures charts of the respective contracts, the ES, the NQ, this is the Russell, this is the YM. And here you can see the upper levels highlighted. You can also see that we have closed above anything that from an auction market perspective could be considered resistance. There is no resistance between where we are now and these levels highlighted on the chart. That doesn't mean we don't stop here and something else develops. It just means that from an auction market perspective, there is no resistance until in the ES you get around the 4,300 level. In the Dow, you get around 13.5. In the Russell, you get around 1950. And in the YM, you get around 34,000. The downside levels will be Friday's session low. If all 4 of these indices take out Friday's session low on a print basis, even much less a close, then it opens up any number of possibilities. And if that occurs, we will discuss those at any point in time. But once again, the bottom line here is that I would expect to see higher prices. The momentum over the past few days coming into Friday's cash session close was the strongest we've had in a couple of years. Now, what you're seeing on my screen includes Globex data, the funky session that began in Sunday evening, and I think it's closed now. I'm not sure, but I wouldn't be surprised if we don't see this entire Globex range retrace and close lower. It's again, the cash market is closed, so what's going on now I don't trust, and we will revisit that obviously in tomorrow morning's pre-market update for members. Let's look at another chart here. Here we go. This is what I wanted to show. Now, if you look at where we are, again, these are the cash indices, so the data is through Friday's close. I'll point out the divergence, and this has been pointed out. This was pointed out last weekend. We had the divergence at this low that almost this type of divergence among the indices almost always occurs, that important pivot turns of the market. The caveat is that you get a lot of negative false signals, and that divergence can be resolved differently. But in this particular instance, it was a heads up. And it was another marker of an impending sharp move. This divergence was going to go away one way or the other. So it appears to have been resolved to the upside. Now I want to compare, just for fun. I don't know if we're in a bear market. I don't know if we're in a bull market, and neither does anyone else. You don't really have to know to make money trading. I'm not in that game. I trade. I'm not in the guessing game. The rally off the February lows in each of the indices, you can see I have the percentage return that it carried. Now, to the next key reference area, the next inflection point, the next area that might be resistance, but it will be an inflection point. If we reach that level, those levels in the respective indices, it ironically will be very close percentage-wise to the amount of rally that we saw off of the February low. Now, there's no magic in that. It's sort of a coincidence. It's not a causative thing. It's a correlation. It will be another reason to be paying particular attention should we reach these upper levels in the next week or so. Okay, let's take a look. The profile view. And what you see here, these are basically quarterly profile units. Each profile unit you see is comprised of data of 1 week. Each letter represents 1 week's trade. Now you can see what a wide range this quarter has been. And you can also see that it appears to be a relatively immature auction. What does that mean? Well, it means there's no pronounced high volume node. Usually these structures, and you can have, everybody wants to see this nice Gaussian shape in all market profiles, but that's not the way it really works. You will almost always have areas of relative value, with the greatest value being the high volume node, which I denote as 25% of the trade in a given structure. Well, right now, this is a very vertical structure. There has not been a lot of rotation. So that's something to keep in mind. We could see a lot more rotation than we've seen. One of the extraordinary things about this market since the top in January has been the verticality, both up and down. So at some point, that's not the normal state of the market. At some point, you're going to see a more rotational market. You're going to see daily ranges come in. This could be the beginning of that. Now, this is the area of that upper key reference area that you see on the bar charts that I alluded to earlier. So if we got up here, then it would be, we'll revisit this, of course, but this could be the upper extreme of an auction that develops between here and this low, to be determined. Okay. Let me find a page here. Here we go. Okay, I landed on this, so I'll start with this. I have been alluding to this chart for several weeks because, and what it is, the market is the S&P cash. The blue bottom middle panel is average true range, 10-day average true range, and the lower panel is VIX. And we have been in an elevated state for a long period of time, an unusually long period of time. Average true range has been high for a very long period of time. I expect this to come in. It would be bullish if it were to come in. And what is likely to happen is that what you see over here, right here, this structure, well, there's been really wide range. It's scrunched up, so you really can't tell. But I wouldn't be surprised if it doesn't turn into something more like this, where your daily ranges just grind higher, but on a much lower daily range. Everything, it's higher, higher, higher. The market continues to make higher highs and higher lows, but the ranges contract. I think that would be bullish. I also think if that occurs, you will see VIX come in, and then maybe VIX gets down to this this 20 level or lower. If it were to do that, that would be very bullish for the market. That would be a bullish signal. Now, if we look at, and this is the breadth work that I share with you guys. And basically, I use something very simple. It's NYSE advancing minus declining issues, or the NYSE issues, the data regarding that, the advancing issues, the declining issues, and then the net of it, which is breadth. And we had 3 of the strongest breadth days that we've had in 2 years since the kickoff off the March 2020 low occurred last week. So that's a lot of momentum. And this is the level that now I'll just highlight it on this chart because it's important. This is that area around 4,300 that I really sort of expect we're going to see. Now, if we do get up into this area in the next week or two, your 10-day moving average of NYSE advancing issues will be rather toasty. And it doesn't mean that there's some sort of imminent collapse in the market coming, but it would indicate at a minimum a more two-sided market and a slowing of the uptrend. Likewise, you can see the 5-day moving average, and this is not a negative thing. It's really a positive thing. There's so much momentum in this market that that typically means that the market will continue in that direction. Now, it's not going to continue in this direction at the same rate of change that we saw Wednesday, Thursday, and Friday, but it's unlikely to turn on a dime here. Unlikely. That doesn't mean it's not possible. It just means it's not likely. So what I would expect to see next week is further strength. It may become more two-sided. I think things can get very, very interesting if we reach up into this 4,300 level in the S&P ES and the equivalent levels in the other indices. So that's something we will be watching for. I hope you enjoy the rest of your long weekend. I'll speak with you again soon. Thank you.